Hi there, Gains Power Cycle Trading. Well, when trading oil, one of the great indicators of supply demand is to look at the front to back crude oil spreads, or what we call timing spreads. So, I started out my trading career trading oil back in the 80s and traded oil in a big way for over 25 years. And so one of the big things that we would do is play these front to back spreads on oil to play, fundamentals of strength or weakness. So what we're looking at here, this is a front to back spread. This is looking at the December WTI contract minus the March minus the February contract. Okay, so what we're measuring here, let me just kind of walk you through this. So this is measuring the strength of a forward curve of crude oil. So this is December, the December contract 2018 minus the February contract of 2019. So what you're seeing here, this is what we call backwardation. So you can see these levels here. We've got the number, plus 0.91, $1.10. So what that is indicating, that right here where you see this top right there, that is telling you that at that point in time, this was back in June 29th, the December contract of crude WTI was $1.40 per barrel over the February contract. So that's showing you super strong strength in the front month. And you can see over in this chart right here, the peak on oil was right there on June 29th. So that peak on that front to back spread was a great indication when it started coming off that this was going to probably be potential for kind of the highs of the oil market. So you can see here, started coming off on June 29th, came back down, popped up, but then it's just been trending lower ever since. So what you want to do is then, you can follow these front to back spreads to see what the real actual supply demand is. And when that spread starts to go into a negative or contango, see the zero right here? So that's indicating, that's what we call contango. That's when the front month, which in this situation would be the December contract, is now trading below that February contract. So it's showing weakness for the front month. And you can see the continuation of that weak trend down for crude oil. So that's a very, very helpful way to identify strength and weakness in crude oil, and these are spreads that you can also trade for great, fantastic profits. So, for example, just to give you an idea of the kind of money that these spreads can make, let me just kind of walk you through that. So, for example, if you had sold right here at 80 cents, if you had sold a the December WTI contract, and then at that point in time bought the February contract 2019 at 80 cents. So you'll be selling the December contract at 80 cents per barrel over. And then if you had covered it here, so let's say that, so you're short the front, long the back, and then you close that trade out at 25 cents. Well, that move from 80 cents to 25 cents, that would be 55 cents per barrel, okay? And remember, one barrel is equivalent to owning 1,000 contracts of, or one contract is equivalent to owning 1,000 barrels of crude. So if you've done this on the futures, 80 cents per contract down to 25 cents, that would be 55 cents times 1,000 to equate it to a futures contract, and that would be $550. So this is a great way to not only make money from a front to back spread, but it's also a great way to look at the fundamental strength or weakness of the actual energy markets. Hope this helps. I'll talk to you on my next video update.